After markets were discouraged by higher than expected US inflation, new data on the Eurozone economy gave investors more reasons to worry. Perhaps analysts' warnings that stock prices have been overvalued provide ample basis for such skepticism. Moreover, investors now suggest that hot inflation data in the United States could mean not only a delay in the rate cuts, but also the possibility of further increases. In any case, forecasts for fine-tuning interest rates in March have to be abandoned. Now, expectations of possible changes in the US monetary policy have shifted to May and even June. As the FedWatch Tool showed today, almost 77% of market participants are considering this the scenario of a rate cut in June. As for the earlier rate cuts, the March meeting now accounts for only 8.5% of forecasts. And the May meeting accounts for a little more than 36.5%. It looks like the so-called last mile for the US Federal Reserve is getting longer due to sticky inflation. By the way, from the speeches of at least 13 Fed policymakers, the markets have never heard statements about a March rate cut. In addition, there is a risk that the situation will go to one of the two extremes. Either the US economy will fall into recession under the burden of high interest rates, or inflation will accelerate again. No wonder Wall Street's reaction was immediate and harsh. The benchmark stock indexes fell down. The losses were so massive that nearly 90% of the S&P 500 stocks collapsed. At the same time, the S&P 500 sank by almost 70 points. On the contrary, yields of the US Treasuries jumped. And today, markets check out between yesterday's inflation report and tomorrow's data on industrial production rates and retail sales figures. Yesterday's bitter pill seems to have tempered investor expectations. The growth of the S&P 500 on Wednesday looks quite timid. Nevertheless, the general bullish impulse is likely to raise the index to a moderate height to the resistance area of 4,980 points. The nearest technical support is located in the area of 4,920 points. The position of the ECB was announced today by several policymakers. Boris Vucic, for example, said that the regulator seems to be fighting inflation currently. Pablo Hernandez warned that the problems for the European economy are significant, and his comments coincided with the preliminary reports on the Eurozone's GDP rates. Today's report showed that the Eurozone economy stalled since December last year. In the fourth quarter, preliminary GDP looked just a 0.1% uptick year-on-year and reached zero. Meanwhile, industrial production in the Eurozone expanded by 2.6% from a month ago and by 1.2% in annual terms. Judging by the market reaction, investors did not believe the incredibly good data on industrial production in the euro area. After all, it was expected that the rate of a decline would simply slow down. The forecast figures were set to negative values, and this would already be a pretty good result. The previous data was upgraded to minus 5.4%, and the decline was followed by an increase of 1.2%. Such a drastic change raises a number of extremely uncomfortable questions. Firstly, it's not clear how this will affect the policy of the Eurozone Central Bank. Will industrial growth become a reason for active easing of a monetary policy? Secondly, how reliable are these data and will they be revised for the worse soon? Even in theory, such data should have contributed to the strengthening of the euro. In reality, its chart was caught in the volatile storm. On the one hand, the market actually got stuck in indecision, and no one wanted to take risks. On the other hand, the US dollar is clearly overbought today, and the euro has nevertheless gained a bullish impulse. As a result, the euro-dollar pair during speculative price swings first updated the local low of 1.07. From a technical point of view, the range of 1.07 and 1.0730 put pressure on the short positions. Perhaps short-term traders have decided to refrain from selling ahead of tomorrow's speech by ECB President Christine Lagarde. Besides, some investors still took into account the positive economic data, so the single currency rose amid a positive correlation with the pound sterling. UK inflation stayed flat at 4% in January, remaining close to November's two-year low and below market expectations of 4.2%. This data supported the pound sterling and, as a result, encouraged the euro's growth. Oil today also showed growth and once again tried to break through the level of $83 per barrel. Most likely this rally is temporary and the breakout will be local. For further sustainable growth, some serious reasons are needed. For example, a notable weakening of the dollar, which is not happening, or a serious escalation in the Middle East. So, the most likely development in the market is a subsequent gradual return to the area of $82 per barrel. Meanwhile, bullish sentiment is prevailing among market participants. However, in the way of buyers, as before, there is a level of 85. Once it's reached, traders could cut the volume of long positions following the recent price rebounds. And for this reason, the main increase in the volume of long positions is expected after the price settles above this level in the daily chart. You have watched a market review by InstaForex analysts for Wednesday, February 14. Join our conversation, ask any questions and share your viewpoints. Don't miss our video. The reliable information is the key to success. See you online.